Everyone in the Code 3 community, good morning. I want to do a quick video on some news stories that I'm sure everyone's seeing. People are paying attention to in the mainstream media. They're talking about the Federal Reserve raising interest rates and reducing asset purchases that are falling on their balance sheet. They're talking about the risks to the equity markets or the stock markets. So I know a lot of people are invested in stocks. And for a lot of folks that have gotten a lot of conversation with us, they know that we talk a lot about the stock market is turned from investing into speculating, and there's a difference. It's typically rooted in buy low, sell high. There's a huge flux of retail investors that have flooded into that in the last couple of years. You can see it on the charts. I mean, when the government started handing out money, it ended up there, not just from retail investors, but from large institutional investors that were seeking yield as real returns went negative with low interest rates and inflation. Well, some of these news stories are written in a way that uh, I don't think is clearly illustrating the simplicity as to why they're worried about the stock market falling as the Fed, excuse me, raises interest rates. So understand that typically what's been considered the risk-free alternative has been the 10-year treasury or treasuries or T-bills or whatever the case may be, some sort of treasury. And it think of it like a savings account for institutional grade money. When people have a capital event or they're looking to do their next thing or whatever, they need to park money for something. They would go into treasuries of some form and hold it for a period of time so they weren't getting deflated. And then when the next thing came around that they wanted to execute on, they would move that money back to liquidity and execute on it. So it's always been considered kind of the risk-free alternative because they couldn't just put it in the bank because that volume of money cannot be insured by the FDIC. So that's one of the reasons that people are worried about um, the stock market declining as money comes out or may potentially come out of the markets and go into treasuries and so forth. Because what happens, the way the Fed controls some of those interest rates, I mean, they have the overnight rate, but they also have when they're buying, when you hear quantitative easing, one of the things they were doing is buying billions and billions, I think 80 billion a month in treasuries. And what that does is it bids up the price of a treasury. Well, when they're putting upward bid pressure on the treasury, that drives down interest rates. Well, now we're seeing the inverse of that. They want to raise interest rates, so they're tapering off their purchases of the treasuries, which is preventing them from being bid up as much, or that's their hope. And the treasuries have been moving up the 10-year here in the last couple of days. And what that'll do is the treasury price comes down, the bid price comes down, interest rates are inverse of that. They will go up. So then you got to think about it. When people were getting whatever 0.9% or something on their money, if they would have parked in treasuries and inflation, say back then, let's just take a number of 4%, well, they're negative 3.1 on real return. So what a lot of money did is it went out on the risk curve further and it went into the equity markets, the stock markets, so forth, trying to find yield. Well, as we could get into everything with the stock market that's showing rather volatile. I mean, there's a record number of stocks in there that are not even profitable. In particular, tech stocks, they're just the share prices keep going up simply because money is flooding into the shares. It's not really a result of their performance. But anyway, people that control large volumes of money understand that. And as the treasuries rise and start giving more yield, then some of that money may come back off that risk curve, meaning they want to take less risk to park their money, and they may come over something more stable. Again, the risk-free alternative, or what's considered the risk-free alternative. So a huge migration of money may take place from the equity markets back to the treasury markets as that continues to go up. And there's a bunch of other nuances than in how money can interact with the Fed at the institutional level. But I just wanted to really highlight on that because the news stories, they're kind of printing in such a way that some of them are indicating, holy cow, here's this migration of money away from the stock market and this may decline. Well, yeah, but they're not telling you why. That's one of the big reasons why. Um, so it's important to remain aware of that and stay informed and so forth. This is one of the reasons we talk about the stock market has turned into a giant casino. If you've seen a lot of our videos, that's what you see. Everybody's been conditioned to buy low, sell high. They only think in terms of US dollars. They're not calculating in uh, deflation in the currency. They're not calculated in a number of things. A lot of people in the stock market, they're not in cash flow. They're just buy low, sell high, and so that's speculating. And then you look at this, people are now speculating on what the Fed's going to do, how fast they're going to do it, and that makes a big impact on the decisions they can or should make. So when you're reading these stories, pay attention to that. Understand that uh, this has been expected. I mean, that's the inverse effect of um, the Fed selling off treasuries and driving up interest rates. Is money is going to be more apt to want to go visit and park in those higher yields where it's relatively safe. They can get out of the risks associated with these markets that in a lot of sense in a lot of places don't make good investing sense. So anyway, hope everybody has a great day. Just want to touch on that. We'll talk to you next time.